Hi, I'm Freddy of Muddy Waters Capital, and I'm here today with Thomas Braziel of 507 Capital. Thomas, thank you very much for joining us today.
Thanks for having me on, Freddy. How are you?
I'm great, thanks. So for our listeners who are not aware of Thomas, he was very early in the Mt. Gox recovery trade. Bloomberg reported you made a 17x return for your investors. That certainly got me very interested to meet you. And as we've generally looked askance at crypto as short sellers, really wanted to get into today how you got involved in crypto, how you got involved in Mt. Gox, and how what you do within the bankruptcy trade claim world is kind of moving into the crypto world, and where you think certain things go from here in the wake of FTX and what looks like a total implosion across everything that touches crypto. If we could start with how you ended up buying a claim that led to a massive win on your side.
Thanks for having me on. Okay. I was already running a small hedge fund and had been buying claims and bankruptcy trade claims, which are basically, most of the time, it's accounts receivable of companies. So think of anything that's not financial debt belongs to a debtor. A lot of distressed firms traffic in this stuff, and it's not, that uncommon. I mean, the market isn't incredibly efficient, but it's decently efficient. It's not like a total free lunch. There's a lot of work that involves sourcing it and papering and managing risk and whatnot, and doing work on these insolvencies. So I literally read about Mt. Gox in the FT and was like, Japanese cryptocurrency bankruptcy claims. Boy, that's a mouthful. Wouldn't it be cool to buy one? And so in 2016, I bought one. And then I was like, that's actually kind of cool, because if these crypto guys are right, or crypto people are right, and Bitcoin goes to $1 million or $100,000, like they're going to make, whatever. They're going to make 100x. I'm going to make 300x. So I guess for me, I just sort of thought it was an interesting, cheap optionality. So I started buying a few, and I got sort of sucked down the crypto rabbit hole. I was always kind of intrigued with crypto, and I definitely say for a long time, and probably still am, I wouldn't say I'm a total maxi or Bitcoin maximalist only, but it's definitely something where I would prefer to be. I guess it's like if you think about crypto and sort of like the most blue chip thing you could be involved in is just really just Bitcoin. Started buying claims. I closed my fund in 18 and started liquidating it. But I still thought the trade was interesting. In 2018, the trustee had sold some of the Bitcoin. And so you could basically buy the claims and get the crypto for free. That was frankly the most interesting time to buy, because what you were doing is you were buying the claim under the fiat in the estate, because he had sold about a fifth of the Bitcoin, as I said. And so the crypto was a free option. So I went all over town trying to get people interested in doing the trade. And I was able to get like one family office interested in doing it. And so we did.
When you say the crypto was a free option, were you buying the claim at a discount to whatever cash and other assets, and
exactly.
The crypto was
free.
Genuinely worth zero?
Free.
Or it was...
No. So there was a lot of, especially in 18, we were buying below the cash value, the look-through cash value. So if I had $100 of claim, so if I was buying a claim for $100, let's just use a round number, the cash on the claim was about $130, and then the crypto was another $200-300. So the idea was you're getting $400 in value for $100, and $120-130 of that was cash, and then the other part was crypto. But at the time, now people, I think Bitcoin in 18, it really ran up to like 8,000, 10,000, 12,000, but you didn't remember it before that, like 15, 16, 17, it was not, people didn't talk about crypto in the same way, or a lot of traditional finance people didn't. So it was kind of a different trade. Like people were like, yeah, it's free, but maybe it should be free. because this is like, not exactly something I would put a lot of weight in. So I just thought it was the most convex thing I'd ever seen. And that's kind of, I think if you, Freddy, you do this, like, what are you always looking for? Like, asymmetry, is kind of the name of the game, I guess, when you're finding great investments. And I just thought that it was...
Every time we talk about asymmetry, people remind us how short selling is not asymmetric. It's it's so grounding.
I like the Jim Chanos. Jim Chanos says, what does he say? He says, I've seen a lot more companies go to zero than infinity, but okay.
Yeah, difference is you only have to be wrong about one going to infinity and well-sized. He also says that short selling is akin to putting out a campfire with your face. I know many more short sellers who have had that experience. Okay, so you found this claim, highly asymmetric, outright sort of standalone, looked attractive as a claim with this free long duration option. I mean, I assume you had people biting your hand off to do business with you and get involved and take as much as they humanly could.
No, actually, it was a very hard trade to place. And I probably pitched, I don't know, over 50 firms, probably over maybe more. And I mean real firms, real distressed firms. And I think for them, some people, the pushback was like, well, this is not big enough for us. Like, what are we going to buy? 5-10 million of this? And I was like, yeah, that'd be great. But for them, they were thinking like, what an administrative nightmare. Like some kid wants me to buy Japanese cryptocurrency bankruptcy claims. My legal cost alone would like double the cost basis. So I think for larger firms, I understood where they were coming from. And then some people, understand, like the family office gentleman that did it with us, it's his own money. It's his dad's money. Versus, when you go into a big firm and the guy's making his salary and he gets a promote, but he's thinking like, cryptocurrency bankruptcy claims, I could get fired over this. It's not worth it. It's not worth the P&L for getting fired because the P&L, I don't see the fee. So you would get these kind of, people would even almost come out and say it like, oh, I'll never get back to the investment committee. And even if I do, I'll have to like stake my reputation on it. So I'm not doing that. Next, what else are you working on? And I was like, that's it. That's all I came to talk about. So that's the other thing is I'd been trading in claims and for the fund I was running, and then I was trying to start to broker them to larger firms just because what you realize quickly is it's hard for them to source even multi-million-dollar claims. Very hard for them to source, and there are firms who do it, but usually it's through brokers and things like that. And if you know enough about insolvency, you can do it. Just like any little niche, once you know enough, you can do it. So that's how I got sort of sucked into crypto. And I wouldn't say I went full in. I really was only doing this trade for a number of years. So. Okay,
so it sounds like it has become slightly more institutional, which typically happens after someone reads a Bloomberg article saying that someone made 17x. What does the market look like now? And when you turn up and you look at a claim in crypto, I mean, there's the famous FTX balance sheet, which I hope not all of your claims look like that, or at least don't look like that kind of when Sequoia wasn't looking at it. What do you see when you get in?
So actually, it's quite fascinating. Okay, so there were a number of small bankruptcies, but I don't think any institutional players really followed them. So we were involved in almost all of them. Okay. And the ones that we really put capital into were Mt. Gox and Bitcoinica. Those are really the only two dockets where we were able to get real money into them and also understand them. And we thought there'd be good recoveries. I mean, you could spend a ton of time on something, but if there's very low recoveries, it's just hard to source because there's almost like a psychological, trait or something that like you're only going to be 5 cents. Well, then I'll just keep it. And so. Fast forward to today, the claims are a lot more complicated. I mean, Mt. Gox was just Bitcoin and then the forks of Bitcoin. But now when you look at an FTX claim, it's got all kind of stuff in there, like all the different currencies. And also like with FTX, like they didn't differentiate between stablecoin and fiat, which is a problem probably under the terms of use and how whether it's trust property or not. So it's much more complicated now. Which in a way I guess is good if you're an opportunist, right? Because it's sort of the complexity keeps people away. And so there are a lot of firms looking. And I would say a number of firms have reached out to us or myself to try to work on this. And always happy to talk to big firms that are real. But I still think it's going to be very hard for a number of them to transact. That doesn't mean they won't. And I think FTX, they've seen a ton of institutional interest versus Celsius and Voyager, much less. Much less. I think also because the client bases in FTX were very different, right? So if you look at Voyager and Celsius, almost all the claimants are just individuals with their life savings on it, which is unfortunate. When you look at FTX, there's a lot of professional trading firms. So think market makers, think, someone might be an individual, but they're an individual with a $5 million personal account. So it's a very different complexion. The claims are bigger. So institutions like that, they're facing counterparties they prefer to face, which is like, a Delaware LLC or a German, regulated hedge fund or something. So these are entities that they're used to transacting with versus like, an individual, like, where do you live? Like Nicaragua. How do I do that? So you have KYC AML issues with individuals and you, it's just not something that typical institutional firms are used to doing. But there's a ton of interest. We'll just see if there's any transactions.
Gotcha. And so we've had all the amazing thing for me about FTX is so much of this is played out over Twitter in real time.
Yeah.
And as we sit here, SBF yesterday interviewed with Aaron Sorkin, who was insane. Personally, I believe he was sat there with a laptop covering his lap because the size of his erection would have been so large at the opportunity to actually do this. I was just, he had this beaming smile, which was almost like, I can't believe I'm doing this. I can't believe I'm doing this. So it's just been fascinating for me as a human interest thing to see this play out in real time. You had the CZ Binance rug pull. They're like, come on, show me what you're doing over there. Pull your pants down. Oh, not for me. I'm going to walk away and let you fuck yourself. But what have you seen sort of post the collapse, trade claims? Is the whole thing a zero?
No.
How does that played out? So far?
So far. Okay, so Voyager and Celsius, when they first filed, those were really the first filings. Those are now looking very simple compared to this, which sounds hard to believe. And they won't be simple because there's lots of issues to unpack. The issue with crypto is, it's an nascent technology still. I guess we're in year 10 plus year, but 10 plus years. But, a lot of the other cryptocurrencies, leaving aside Bitcoin, and a lot of the actual legal determinations of what crypto is and who regulates it and how it's, how contracts are interpreted, all that stuff is pretty new. And you haven't had big, firms like White and Case and Kirkland and Kirkland Ellis. These are firms that are engaged in these cases, arguing over really specific and novel concepts, like even something as simple as a preference when it comes to crypto. Well, how do you determine normally in preferences, you would look at what the actual value was at the time of the transfer. But like actually calculating that can be really hard. Like, okay, think of someone's claim value. Like, not only will it be the time of the filing, but it could also, you have an issue around like, literally like time stamping. Like, when was the exact time that FTX or Voyager or Celsius filed? And that could change your calculation by a few $1,000s or a few $1 million. So these are actually quite novel issues. That some have been tested in different ways, but never in such a grand scale. And I would say, so what are we seeing so far? We're seeing a lot of people trying to get involved. I think that institutions now, it's almost like an imperative to show that they're not, they're with it and they're sort of like following these cases. I honestly think that's the only reason they look. Some of the older guys and girls, I think they sort of probably think like, why am I even bothering this? And they ask really kind of questions that you think, maybe you should just go off and study crypto and come back and we'll talk about the restructuring a bit. But the younger people, I think crypto's here to stay and the genie's out of the bottle. The one thing I will say about the cases is, I think the hard part for a lot of distress firms is you have to sort of believe in the underlying asset to be able to participate. Sometimes there's this idea that in distress, you just buy junk, and you just like liquidate it. And okay, sure, there's some of that, but a lot of the best trades and deals are where you catch, something that rebounds, whether it's oil and gas restructuring, you convert into equity, or I don't know, coal. The guys that probably did coal deals, rare earth deals, whatever. And I'm just using those because they're big commodities, but they're big companies where, whatever, a gym chain or something where it goes, you want it to come back. If it doesn't come back, it's a little harder to make money with the deals. I mean, you can squeeze out profits, but they won't be home runs. They'll be base hits. So, a lot of interest, but I don't think a lot of transactions. I think the market's still trying to find its footing. I mean, I was hearing this morning from, about a large company that people are talking about, even on Twitter, about filing any day now. And it's just all happening in real time, and people are really trying to assess, what's going on. So a lot of looking.
I mean, we're about, I guess, 2 weeks out, and I only know this because Schadenfreude is like slowly left my body as a no-coiner, slowly returning to just normal levels of short selling Schadenfreude, which, given the market's down, reasonably high. I mean, post-bankruptcy, where were claims trading? And as you said, it's much more complex than Voyager. Are there several different types of claims?
Yes.
How has that worked?
Yeah, so, okay, we can go through all the dockets if you want. I'll do it quickly, and then I hope it's not too much. But if you look at something like Voyager, there was always they filed with like a pre-pack or pre-arranged, wasn't a pre-pack, but sort of a pre-set deal in motion. Like, hey, we're either going to do a debt for equity conversion where we're going to give you the crypto we have, and we're going to do the new co-equity, or we're going to do a sales process. They have what's called a toggle plan. And so I don't think there were that many claims that traded in Voyager. I mean, we've been involved, but we're not big owners. I think probably earlier on they were trading in the set 60s with the implied idea that SBF was going to buy the business and pay you out 72 and call it 6 months. And now they're trading down probably in the 45, 50 context. There's not a lot of different types with Voyager. Voyager is relatively simple. We'll get more complex and more complex. Then if you move on to Celsius, you have probably two pockets of claims. You have the earn account and you have a custody account. The custody account claims, even though I think the UCC, the Unsecured Creditors Committee, has come out recently in support of the custody accounts being treated as actual custody account, it was created within what's called the preference period, which was 89 days before the petition date. But there are two markets for those claims. No one really transacts in the custody claims. I mean, I've seen people like giving in indicative quotes, which means not actual, transactions. But the actual transactions that I know about, I think early on they were probably trading in the 30s, or actually they started in the 20s, went up to the 30s, and now they're sort of coming back down. And now they're really probably at 20, maybe even sub 20. I mean, crypto's come down too, so you have to like look at that when you look through at the recoveries. But the idea is you're paying 20 and you're hopefully going to make 35. And again, there's those two pockets. There's the earn and the custody, but really no one's touching custody. And custody is a small pool. It's only about a $110 million pool or $120 million pool. So for a claim pool, you have to think like, how much of this pool can you buy? It's almost like looking at market cap. Like, how much of this company can I actually short or go long or short? It's like 110 million. I mean, maybe I get 5 million of this. So it's really hard with smaller pockets like that. But sometimes you can get a juicy claim. And then moving on to FTX, the pool is bigger. You're talking about almost a $10 billion pool. But the complexities are really there. There's probably two sets of claims right now. You have the professional trading firms that were doing market making and whatever you want to call it, like carry trade stuff where you're buying this and you're selling the future, and you're just sort of like taking that spread. And so all those spread guys, those are cleaner claims. They probably have some, again, preference issues you need to look out for, but that's like one. And the pricing, I'll get pricing in a second. And then you have some really complex claims, which are probably like the treasury claims. So think of like anything that was a Solana project that had all their money on the treasury of these companies. They actually have a claim. The question is like, is it dollarized, or do you get the treasury back? And who's going to want, Solana or Serum or whatever project they have when the actual underlying, sort of ecosystem is dead. Like all the investors that were in your capital table aren't around, and there's no FTX to support you and Sam Bankman-Fried to support you. So the pricing started really low, like 2-3 cents. Actually, I shouldn't say that. Pre-petition, I heard of some guys trading at like 80 and 70, and I don't think a lot traded. And then it quickly went to 50, and then overnight it went to like 10. And there are a few firms that pre-petition bought some stuff in like the 10, 15 context. Not big numbers, but they bought stuff. And then if you go further down, you'll see, if you keep going forward in time, once they filed, they basically the pricing fell to 3. And then it picked back up from 3 to 5, 5 to 6 to 7 to 8. And now there is some floating rumors of quotes in like the 10, 11 context. But I got to tell you, I mean, the market for claims is always so weird because, you hear these quotes, but then it's like, did actually transactions happen at those numbers? Right. So you get a lot of that. I don't know. I can't think of an analogous market, but in our market, like it's a real thing. Like people say all the time, like, yeah. Like that actually trade, so people will say things like that all the time. And they're like, that's not a real number. And I think right now, if someone really needs to transact, it's probably 5, 6, 7. There was a 6.25, I think, deal that was quite large that went off, but then I heard that deal didn't close. So I think it's really hard because the claims are complex, and I think the market's having to find itself. And I think sellers are going to have to get some of them are realistic, some of them need to get realistic. If they need liquidity. If not, right now, John Ray says he has 1.4 billion or something like that. And there's probably $1 billion of venture, but or $1.5 billion, but you've got to discount that incredibly heavily. And then you got to take out attorney's fees. So you probably get somewhere in the, call it 10, maybe 20 cents on the dollar recovery. If you take like 2 billion and then you put it over 10, you get 20 cents on the dollar. So you got to get a big discount to that, because it's going to take years. It's going to be probably 3, 5, 7, 10 years. I mean, think of how long Madoff took, or think of how long, I don't know, Lehman or Enron. I mean, those are the big marquee cases that have similar rhyming themes to these. I mean, I wouldn't put it, it's not a Ponzi scheme, but clearly deeply troubled transactions happen, which will require a ton of asset tracing and whatnot.
And is there additional complexity because this is in the Bahamas, or is that vanilla?
No, it's not vanilla. It adds a little bit of complexity. I wouldn't say it's an insurmountable complexity. The fact that it's crypto adds complexity. I think the Bahamian thing isn't as much complexity as the English law determination and the terms of service, which add some really interesting wrinkles. If you really think about FTX and you read the terms of service for any of the international claimants, they're supposed to be held in trust. And this is like what Sorkin was talking about yesterday, right? He's like, well, when you were commingling your assets with your customers, I mean, was there commingling? Like, because when you think of your broker, if you own 100 shares of Apple, you don't expect him to be, pledging your collateral. Or I don't know exactly how that would work with electronic brokers, but I think there's really supposed to be a strong separation between like firm assets and client assets. Anyway, the terms of service here are pretty clear that they say that it's held in trust and it's interpreted under English law. And I think that's the real complexity. The Bahamas is fine. There was some jurisdictional fighting between the Bahamas and John Ray already. And I think there will continue to be a little bit of sparring. But so far, if you're doing round one goes to John Ray because he's already gotten the Chapter 15, it's called, that the Bahamian liquidator filed, moved from Southern District of New York to Delaware. So all that means is it'll be moved to the same judge that's overseeing the 11. And guess what he'll do? He'll say, oh, you want to take my case away from me? No. I'd like to hear the case. Keep counselor, you can continue. Denied. Chapter 15 denied. John, please continue. What were you saying? So it'll be one of those. I mean, so yeah.
Fascinating. And so we touched on the conversation Sorkin had yesterday. Like all of his stuff was just, I was trying to think of a parallel in my lifetime for someone under that much scrutiny interviewing. The closest I kind of got was it was the equivalent of OJ in the Bronco being interviewed by Oprah with Lance Armstrong and maybe Tom Cruise doing the kind of sofa jumping in the background. You know, with like maybe Monica Lewinsky riding shotgun alongside and a little sidecar. I mean, for me, it's just unparalleled. I mean,
when you short stocks, does this happen sometimes where the guy's like, "Oh man, I'm probably caught here. I should just try a different route."
There are a few occasions I can think of. Dan Yu of Gotham Research shorted a fraud called Gowex in Spain, and I think he published his report. It was back in testing my knowledge here. It was back in I think 14 or 15, and he shorted the company. It was ostensibly a Wi-Fi platform similar to Boingo in airports.
Yeah.
And stock fell significantly on the day of the report. It was really excellent work. And that weekend, the guy, the CEO, just walked into a police station. He's like, "You got me," and we're like, "Wow." That never happens. Now I think
see that as a catalyst.
No, I think there are some other reasons behind that, but we're like, wow, that's lucky guy. Like, never happens to our short sellers. Omar Khan, we shorted back in 13 a company called NQ Mobile. They had like pre-installed devices on mobile phones. It was a complete fraud. The CEO did go on CNBC and really couldn't answer any questions, and it was horrific TV. We used to refer to Omar internally as a sock puppet. And so that's as good as it gets. You very occasionally get a CEO who is not particularly well-versed or a kind of knee-jerk reaction. Says like, yeah, I'll go on TV, and it's horrific. But typically you don't have as much publicly out there from the person or the company with which you can have an interviewer who is as high a quality interviewer as Sorkin to kind of really sit there and just skewer someone. So I can't think of a time in my life where I've ever seen anything like it. And I mean, as Bankman-Fried said, when he was asked, well, what are your lawyers are saying? And the answer was quite obviously like, well, don't do this. I don't know. For me, that was good fun.
I mean, look, there are legitimate reasons that people don't, even when, let's say a short report they don't agree with, they still don't need to go on TV and back themselves in a corner in some way or make statements that then could be considered materially false later. I mean, even if there's just disagreement about the way something's being interpreted. It's definitely fun to watch. For creditors, I suppose it's good because they feel like, and he's giving numbers on the recoveries. I mean, I watched it this morning because I missed it yesterday. And I was just like, what is he doing? He's giving like recovery numbers? Like, this is bizarre. That's a first. That'll be a first in the bankruptcy context. I can't say I've ever had somebody of a deeply troubled finance. Actually, that's not true. I've had one other instance where a guy, that was different. He was getting divorced from his wife. And on the eve of the final decree, he filed the company for bankruptcy because he didn't want her to have it. And I was like, wow, that is some spite, brother. And it was a long story, and it was like a fourth generation family business. But he did do that. And then he called all the creditors and told them they were going to get 100 cents on the dollar, which of course totally screwed up the market because everyone thought they were getting 100 cents. And of course, lo and behold, they didn't get 100 cents. They did get about 60, 70 cents on the dollar. But it's like everybody has like endowment bias. They have a phone, so they think their phone's worth the $1,000 they spent on it. It's like, no, once you've used it for a few months, it's worth like $200. And so I think even companies, you have this issue. They're like, oh, if we liquidate this, it'll be so much money. It's like, yeah, it's a used share. So anyway.
Yeah, but I mean, aside for that, I was pretty astounded by the recovery and letting the VCs off. that to me said like, look, here's a guy who once he's on the back end of it is probably going to pull an Adam Newman and try and raise money again on the basis that he's just telling everyone like, oh, it wasn't the VC's fault for not really closely looking at this.
Well, it's interesting. So Mt. Gox was Mark Capellas. Mark Capellas is starting a new company.
Okay.
And he's doing, you're going to love this, a credit rating agency for crypto firms. I was like, oh, that's an interesting idea. And he's actually calling it Ungox. And I'm like, oh, right, Mt. Gox, Ungox. Oh, right, get it. Yeah, I got it. I think that's a bad idea. I suppose doesn't Jeffrey Skilling do like fraud, like coaching or something?
So I know Andy Fastow speaks.
Oh, Fastow. That's what I meant.
Yeah, he's a fascinating individual for many reasons. I think he currently works for the law firm maybe that defended him, and then I believe he has a startup that is somewhat fraud adjacent. I think it monitors emails and it looks for certain patterns, I think, within emails, but it's sort of an internal piece of software, so you as the company can work out if there are problems with your employees,
controls and things like that.
Yeah, so that's like my understanding. I mean, it's interesting you talk about the ratings agency. We many years ago kind of jokingly internally, just given there are such profound issues with the ratings agencies in the US, and our view that like the numbers out of China are just, they're not real. I mean, I'm not saying that Alibaba doesn't ship some number of packages or Tencent doesn't really have online games. Of course they do, but are the numbers as real as what you expect from Netflix and Amazon? I don't think so, and I don't think anyone does think so. We jokingly internally said, we should do a ratings agency for Chinese companies' numbers, and we should just grade it on kind of real to total fraud. So, if you're really big and complex, and like probably we can't work out how real or not you are, you get like a good rating. And if you're just flailing on the floor, clearly a complete fraud, like you get a fraud rating. And, jokingly again, like we would never do this. So we would say to people like, look, very similar to, the US, if you don't like the rating, you just pay us and you keep it internally and you don't stick a rating on your stock. And then we can't short you because we're conflicted. So that was the internal riff on it. But
I love it. Pay you not to work. I like that idea.
Exactly.
If you don't
unfortunately,
want us to work on your company, you can pay us.
Yeah, I mean, unfortunately, that I do believe is blackmail, so we can't do that. But
sounds like greenmail to me. No,
exactly.
It might. Yeah, nothing here is financial or legal advice. Yeah, I don't know. That's an interesting idea. I mean, Ungox, you guys. Well, anyway, continue.
Yeah, so actually, touching on the wider crypto landscape. I mean, what impact are you seeing in claims and how this has kind of caused liquidity to pull back within crypto?
Yeah, so there's just been a ton of liquidity pulled out of the system. If we think of any venture deal, anybody trying to raise money in the whatever seed, Series A, B, C, D, whatever. I don't do the whole smorgasbord of venture round nomenclature, but all those guys are having a very, very hard time. The big boys have sort of tamped on the brakes. I'm sure there's some deals still getting done. But the other side to it is, the whole lending market within crypto. So anything that requires working capital, all those relationships are stalled. Sometimes because they have a zombie lender. Maybe Celsius was their lender, or maybe Genesis was their lender. And so these are issues for those companies because they're like, oh shoot, I was working on a restructuring, but I don't know who I'm going to be talking to next week because it could be someone new. And so there's turnover at the firms, and so it just leads to a lot of uncertainty. And so I guess for us, we see it in the claims. We see tons of liquidity coming out. People wanting, firms having redemptions from LPs, and everyone's trying to get simple fast. That's the other thing I'm sort of noticing is a lot of firms wanting to trim things down and try to make it as simple as possible, which makes sense. The problem is everybody's trying to do it at once. So I suppose this is the thing of all markets, but I wouldn't say they're running for the fire exit. They're sort of like being like, oh, you know what? We're taking a timeout on new deals. Well, if everybody does that, then the capital just sucks, like oxygen out of a room. I mean, it's really amazing to watch. But there are deals out there. It's just the question is like, who gets to capitalize on them? Probably family offices are better positioned than large firms, and I would say, and then more. I would say the smallish firms are probably more nimble. The problem with all the guys in crypto, and I'm sure everybody that's been through big distress cycles could say this. It's like the crypto guys are bleeding themselves. So the guys that know the most about the assets have a really hard time transacting because they themselves have their own balance sheet issues. I mean, you can talk about big name people that, you could talk to them about a stress deal, but they're also like looking at, shoot, I had, I used to have 300 million. Now I'm worth 100. So people are, they're bleeding, like I remember once I had a friend who worked at Bear Stearns and I said, 2009 blood in the streets is when you got to buy, right? And he was like, yeah, Tom, but remember, it's your blood. And I was like, ooh, he's not wrong. And I think it's true right now in crypto. So really any opportunistic investors can move into the space. Like the quote unquote domain expert capital is not super deep right now. In fact, it's going the other way. Anyway.
So are you partnering then with individuals who are coming to you who have that deeper crypto knowledge, or are you very much focused on the claims that are there and working through at that end?
So my principal job is working for this family office when I'm sitting in right now, and our job is just find good deals to do. We're not like trying to gather assets. We're not running billions of dollars, but it's a decent sized family office, and we can do deals of a few $1 million. I mean, generally the target size for us is anywhere between $1 million and $30 million. But with crypto, of course, your deals have to be smaller because just the nature of how risky what you're doing is. We'll partner with people that have either domain expertise, but that's not. Sometimes you need people with domain expertise, and sometimes you need just capital partners because the deals are too big or they're complex. But yeah, I mean, we're just principally looking for deals ourselves. And we have no problem either sharing or something that doesn't work for us. I mean, we were looking at a few deals earlier this year, and in particular one recently that we just had to pass on because we just didn't have the bandwidth to do it. It's, you've got only, let's call it 10 people on an investment team, and you have to say like, okay, this is a lot of brain damage, and is it worth the P&L for the brain damage? So with crypto, you really have to say that. You don't have the same issues around like, oh, our firm policy now is like no more crypto deals or no new crypto deals or no crypto deals at all. We don't have those kind of rules, but we'll work with people. I think domain experts are helpful, but right now these are more legal questions about how a lot of this stuff is interpreted. And I was having a conversation with a guy this morning who's working. He's connected to a very large claim in a case, and he was trying to fish around for legal interpretations. And I was like, you might be right, but there's no way that I can pay you based on you might be right. So if you really want to sell this, like you got to get more realistic about the fact that this has never actually been interpreted in a court of law. Mm-hmm. So those are the issues. It's just the bid-ask spread right now is huge. I mean, and so that's why you see prices everywhere, but it's like, where are transactions actually going to get done? And the guys that don't get deal fatigue and can stay close to these things will probably do the best,
And do you think, this will just end up being, as you said, much of this has never been dealt with in courts of law, like much of crypto. And, I'm curious if you think this will actually be foundational, assuming crypto doesn't go away, which, truth be told, I couldn't care less about. But that's just me. But assuming crypto's here to stay, do you think this will really just end up forming the basis for not just bankruptcy related questions, but actually much of kind of legal crypto questions. Law and regulation?
I think so. I think a lot of policy groups will watch these cases and they'll push for certain things. They'll push for certain regulations and regulatory frameworks and stuff like that. So take, for instance, in traditional finance, you have something called like a 546e safe harbor. This is like if financial parties are transacting, it's not subject to a preference. It's more complicated than that. It has to do with financial intermediaries that are transacting in either a commodity or securities contract. But basically, the idea is to stop contagion within in the financial industry. And so the question will be like, does this apply to crypto? And I think if it does or it doesn't, clearly out of these cases, people will say, we really need to kind of put that in because, contagion within a financial system isn't great. And crypto is basically that, right? It's sort of hopefully a new financial system that So yeah, I think there'll be lots of policy and hopefully decent case law that comes out of these cases that will inform crypto for the future, for the next 100 years, 50 years, whatever.
Gotcha. Anything else that you're looking at outside of crypto that we should be focused on? I mean, it doesn't have to be the next 17x. I'll settle with a 5 to 8x. Obviously, I'd want that accelerated in terms
Freddy, you know where everything is. You don't ask me. You got. I'm a believer. I think I said this to you or saying to someone else. Like there was this Peter Cundall. You know him? He's like a famous Canadian investor, and he always said there's always something to do. Or that was the title of his book. But I think I think every January he would go to the most beaten up markets. And just look, like he would spend, I think in his book, he said a month. God bless his wife for like going to these crazy places every year. Maybe she was down for it. Anyway, so he would do that. And I think there's opportunity everywhere. This is the thing. The only thing I say about crypto is like a knock on crypto is sometimes people are in crypto. They think that's all there is. I'm like, okay, I need to like time out. Like, let's just like have a crypto break. And, there are other things going on in the world, whether it's, growthy industries or whatever, software, or even industrials, new technology. I mean, there's just a lot going on. There's lots of ways to make money. So that's such a silly construct. I mean, for us, like for whatever reason, we're looking at crypto. We've been looking at coal. And I don't know, coal. I wouldn't say coal. I mean,
those kind of bookend humanity, right? You've got coal at the start and then crypto.
I think the thing about coal, which is interesting, and probably about oil and gas in general, is there's just like weird, the ESG movement, while good intentioned, and I don't want to get too political about it, but the capital is just again leaving the marketplace.
Yep.
And if you think about transition or energy transition, I mean, it seems like wow, like. When you look at the deals and you see the numbers, you're like, and this is real? These numbers are real? And you're like, wow. And you're in, North America and you can make that kind of, IRR. You can underwrite a 20 or 30% plus IRR. I'm not saying you do them. I'm just saying clearly that's an interesting place to look. Like you're not really betting on heroic things happening. All you're kind of betting on is sort of a little bit like, kind of the same. And, if your paybacks are that fast, then generally that's a good place to be looking. But there's always stuff to do. There's always a fraud out there to short, right, Freddy? I mean, there's always like some company that's, so.
Yeah, no, look, for our purposes, there's always a bull market somewhere. So that's generally where we're focused on finding the bad actors. I mean, look, it's interesting you said that. And I wonder how much of that framework comes from having that distressed background that naturally, you haven't spent your career in one particular industry necessarily, or you haven't spent it in one specific kind of niche asset class, which naturally anchors you to continuing to look at that. The nature of being a distressed guy is that you're actually just constantly chasing the most recent tire fire and waiting to see what's going to be there.
I hope you're not too early.
As it could.
As I think Klarman says, we buy too early, we sell too early, and we hope to make money in the middle somewhere. But I definitely think it's true. If you're like, I wouldn't put myself in just a distress. I kind of think of myself as like, what is it? I'm trying to think the way he puts it. But just like opportunity investing, it's like you sort of want to run to where the thing about oil and gas and coal that's interesting versus like crypto or other things is when you do crypto, or when you look at, like, for instance, we had looked at a Jones Act shipping fleet that was bankrupt, and you're looking at historical asset prices, but like when you look at your yield, you're like, ooh, boy, let's hope that the yields come up. Like we really need the market to come back. So when you're underwriting it, you're having to look back and then kind of normalize earnings. When you do the oil and gas and the coal stuff, you don't have to do any of that. I suppose you could say, maybe we're in a super cycle and you need to normalize that down some. But when you look at the numbers, you're just like, wow, that's so again, it's not, you don't have to do all this mental gymnastics you have to do sometimes when you're like looking at Jones Act fleet. You're like, okay, this is worth $1 billion. I could buy it for $100 million. Wow, that's cool. And if I can get financing, I'm really doing great. But when you actually look at the cash flow, you're saying like, ooh, the market better come back or this is going to be a really bad bet. So, that's implicit to me. That's a little harder. But yeah, I think opportunity investing is an opportunity. There's just opportunities everywhere. And if you keep that mindset, I think you can find them. I mean, I don't know how you actually got into Chinese short selling, but that was such it's still a great trade. But when it first, the China hustle and all this stuff, like these are amazing pockets.
Sadly, the question I'd much rather you're asking is, I don't know how you got into venture investing 15 years ago. And I'd be like, well, behind me, you'll see my yacht. And if you look far into the distance, that's my second plane because I've just upgraded to a G6. That would have been a better place to be for the last 15 years. But
but you have to choose what matches your mindset too,
true.
Like what you enjoy, right? I mean, for me, I kind of enjoy, like, I don't want to say proving the impossible, but trying to sort of do the just doable. It's like, what do you want? You want something hard but not impossible.
Yep.
And I feel like if people say that in certain areas, I feel like that's true in some of the stuff we do. You want something kind of hard but not impossible. So like the art of the doable. I think a friend of mine that works in litigation finance puts it that way. I'm in the business of trying to do the art of the doable. So I always think that's a great way to think about distressed or opportunistic investing.
Yeah. Well, listen, Thomas, thank you very much for joining us. Really appreciate you coming on. For people who are out there, I strongly recommend getting in touch with Thomas. It's been fascinating speaking to you both on crypto and general opportunistic investing. And I look forward to having you back on in 5 years' time when you can tell me how the claims that you bought trading at 3 and 10 cents are trading at like $6.
I hope I can tell you that story. We'll see when we are deploying capital. So let's hope it. But thanks for having me on, Freddy, and it's always great to chat.
Great. Take care.
Thanks.